Pause me, okay? We'll be right back. We'll be right with you. Well, good afternoon, everyone. Welcome to Trading Index Options. I'm Connie Hill, sitting in for Ben Watson here today. Glad that you've joined me. Do you think that you personally would get bored of trading the same index over and over and over again? Do you think you personally could handle that? Or do you think, oh, that would just get too boring, Connie? I don't know if I could do that. Let me know in the chat because we're going to talk a little bit about that here today. I am joined in the chat by Brent Moores. So happy Brent is here. He's a great coach, great friend. Been able to work together over the last 20 plus years. He's a great veteran of the market. So as you have questions, go ahead, shoot them out to us, okay? I'll keep my eye on the chat. Brent will have it, be looking at it as well. There might be some things he might need to answer for me, but we do want your questions. If you're listening to this on the recording, and I know lots of you do, when you have a question, put them in the comment section in YouTube, because we go back and look at those throughout the day so that you can get your questions answered as well. Now, I hope you're following us on X. All of us coaches have X handles, and we'd love for you to follow along. I'm Connie Hill CS. Brent is Brent Moore CS. We'll post educational content while we are noticing things throughout the day, things that we think you might find interesting because we found it to be interesting. All right, let's go through our disclosures and get into our agenda here today. What we discuss is meant for information and education only. Don't consider it a recommendation. Past performance is no guarantee of future results. American style short options can be assigned at any time up to expiration, regardless of the in-the-money amount. We probably aren't going to have to deal with those here today. When we talk about probabilities, they're theoretical in nature. They're never guaranteed. You need to be aware of that. There's no guarantee that an execution of a stop order will be at or near the stop price. Typically, they trigger, but then they line up with all the other market orders that need to be filled, so the price is never going to be guaranteed. We'll be using the Paper Money software application. It's for educational purposes only. However, I think it's a great way to learn strategies, learn index options, learn the things that you're not familiar with, do them in your Paper Money account first before you go over to your live side. Now, I'm going to look and see how some of you guys responded to me. If you thought you could handle trading the same index over and over and over again, Kelly's a no. Life of the Fast Lane says yes, and Chiefly says you could. All right. When did this class time change, or has Ben on vacation? Yeah, Ben is out right now. He probably will be back next week. I know he's been out a little bit. Sometimes he has some travel, but he should be back next week. All right, so some of you think you could handle it, which is good. You're the ones that responded to me. All right, just want to make you aware of some upcoming workshops and market drive events. Anaheim, Houston, Miami. Notice they're all in nice sunny weather when we start getting into colder temperatures. So if you can arrange to get there, we will treat you like gold. You'll be so glad you went. We just finished at one in Orlando last weekend, and people that I've seen put in comments, man, they were happy they attended that event. So if you can get there, please do so. Okay, typically we'll just kind of take a look at what the market's doing. Do we think we're a little bit more bullish, more bearish? We're going to talk specifically about just trading one index and why we might consider just trading one index. Okay. And I'm hoping that for you personally, with that one index, you wouldn't get bored. You wouldn't mind it. Okay. But we'll see how you feel about these. All right. Let's head over to our Thinkorswim platform. Last week, I was helping out Ben again in this class, and we had a bit of a fury, right? I told you it was an experiment, and if it didn't work out well, I would not do it again. So I'm not going to do it again, at least today. But we're going to take it at a little bit easier pace today, okay? Got the SPX up. Kind of been a little bit of a volatile day, hasn't it? As we look at this candle right here, the shadow to the top, a little bit longer shadow to the downside. So we've had a little bit of range in here today, even though the price right now is just a little bit below where it opened this morning, right? That's why we have kind of the filled in red candle here. Moving averages. I've got a moving average of 10. These are all simples. We've got 10, red is 50, purple is 100, green is 200. Now, sometimes people might take the approach and say, well, I'm going to be bullish on whatever my outlook is as long as some of the major indexes are above their 100-day moving average or above their 50-day moving average, right? Maybe they would consider maybe not being as bullish on the market, and they might take a more bearish stance if maybe the index was starting to show weakness, that we were starting to trade below, say, a 50 moving average on the way down to a 100-day moving average, then yeah, some people might change that. Now, I put the ATR on here just so we could see what that extreme sell-off did to the ATR last Friday, right? We had this giant red candle, wiped out several days worth of positive price action. And that ATR, man, did that fly up there, up probably higher than it's been in a long period of time. So just know that it might be elevated a little bit right now because of the great sell-off day. But if let me give myself a little bit more space here. You can see, even though it just spiked here today, it's not as high as it's been maybe in previous times when we had this big sell-off in April. The ATR definitely spiked through there. So this could be the beginning of a spike. We'll have to wait and see what it does over the next little bit. All right, here. Jay Richardson said, I started to paper trade SPX every day in my paper money account. Once I'm comfortable, I'll take it live. Jay Richardson, I'm happy to hear that. Yeah, you're practicing it, getting comfortable with it, getting an idea of how it maneuvers, getting an idea of what's volatile on a given day, what's not volatile. And the way we do that is, yeah, just doing exactly what you're doing. So I would encourage other people to follow your example, and I bet others are doing that here as well. All right. So as we look at the S&P index here, we're seeing, I'm going to say it's above the 50-day moving average. We're probably looking a little bit more bullish than bearish, even though today it's kind of been a little bit volatile, been all over the place. And you could maybe look at intermediate positions or short-term positions, maybe in a bullish direction. And if you're somebody that's doing some real short turnarounds, maybe you're just following the momentum for the given part of the day. All right. SPX is the index we're going to focus on, but I'm going to show you why. Okay, I'm going to come over here to the trade tab, and I'm going to bring up DJX first, the Dow Jones Index. Okay, for the options that they have available, they've got October, November, December, and March. Okay, these are basically monthly expirations. And so the ones that have, just one more day till they expire, which will be Friday, right? We can look out here at the volume and the open interest. You're like, it's kind of scant, right? And there's a couple of strike prices that have a lot of activity, and the other ones just really don't have a whole lot. And they're not that frequent, right? So you could only trade it for those monthly series that you see out there. Now, if we look at the NDX, on the NDX, let's kind of show you what they have. They have weeklies available. DJX did not have weeklies available. They have the ones that expire every single trading day. every day, every market day here, right? Ones that expire today, ones that expire tomorrow, ones that expire Friday in the morning, AM settlement, ones that expire PM settlement, okay, and so forth. And we can see, oh yeah, man, we can go out here basically, how long will this go out? This will go out 36, oh, actually longer than that, 37 days before getting into a bigger gap than just one day. Okay. Well, do you think they're liquid or not as liquid? Okay, I'm going to choose the same one that I showed you on the previous one. We'll choose the ones that expire here today, although the ones I chose on the other would be for Friday. But here, as we look at these, we can see, man, volume. Look how much volume there is on this today compared to the open interest. On some of these ones that expire every day, that's going to be really common, that you're seeing a lot of activity the given day. But at the beginning of the day, maybe there wasn't as much open interest. We're seeing that on both the call side and the put side here of the NDX. It's more liquid than what we were seeing on the Dow Jones. And let's look at the Russell 2000. Russell 2000 tracks the small cap stocks, right? And same thing here. I'm going to kind of scroll down here so we see ones that are closer to at the money. We're seeing maybe just some lighter open interest here on both, the put side especially. The call side is a little bit more liquid out here. Of course, the Russell 2000 has been quite bullish, but really a lot of them, not totally, but many of them have more volume today than the open interest. But it gives you an idea, hey, is this easy to get in and out of? And if I want to buy something near the money, maybe do a spread, is it going to be easy to get into and out of? Well, if you're looking at, say, a 25.15, 25.20, yeah, there's lots of liquidity here, right? But say you're going out of the money, and say you want to be out of the money at, say, a 15 delta. That's a 1 delta. But say way out of the money, say a 7 delta, 13 delta. Some of them are going to have enough traction there for you, but sometimes they might not. Okay. So I want you to be aware of that. Now we're going to compare that to SPX. Okay. We've been, I know Ben will kind of change things up a lot, but you'll notice a lot of times we're just going to be going for the SPX. And as we look at the volume and the open interest here, we can see, yeah, why is it maybe that a lot of people are trading it, right? That makes it advantageous for us because lots and lots of contracts, and same thing here, tons of volume, not as much open interest. That's telling us lots of daily activity, okay? If it's something that maybe is out of the money, you might maybe think there's more selling activity for those. Maybe closer to in the money or at the money, maybe there's sort of more buying activity, but it doesn't really matter. The key is that the activity is there. The spreads are really nice and tight. So 540 by 560, that's 20 cents. That's not too unreasonable. 4 by 410, 10 cents, not bad, right? Another 10 cents, 10 cents, 10 cents. Okay. It's going to be the same thing on the call side of things, right? Just the narrow bid-ask spread. And that makes it easier for us as traders to not have a big gap, that our movement or our stock or index, whatever it is that we're trading, doesn't have to move so much to make up that wide spread. If it needs to, if there is a wider spread, it puts the trader at a disadvantage because you're like, oh, I need a bigger movement just to get beyond kind of the break-even point there. Now, I'm just looking in the chat here, and I see we have placed out in the chat a survey already. You guys know we do surveys from time to time, and I can do an easy survey. This is a pretty easy survey. You can do 2 radio button questions, plop, plop, just pick your number on a scale of 1 to 10. What do you think? And then there's 2 questions that you can answer if you want. I'll also encourage people to use it as space to write to me if there's something they would like to cover in one that I like on my regular schedule. Or I would also say in this case, I'm just taking this over today for Ben. If you wanted to communicate something to Ben that you would like him to cover, go ahead, spell that out. Okay, I'll share the results with Ben. But the idea is, as you find maybe situations you're like, man, I'm really kind of struggling with X, Y, or Z, right? Can you help me with that? We love to incorporate that into our webcast coming up. Okay, so whatever you write down, I promise I will read. I promise our managers read. We're really interested in your feedback. Okay, class isn't over yet, but if you just kind of click that link, it'll stay active in the background. And then when it's time to go or we close up shop, then you can go ahead and fill that out. Okay, once the class is closed, it disappears. Brent will post it in there again. All right, but and we'll remember to remind you of that. But we do appreciate the time you take to fill those out for us. Okay. Looks like I think this is Gary Keller. You trade the rut a fair bit, bad price discovery due to the low volume. So does not have as much activity as the SPX. It doesn't mean that you shouldn't use it. Just make sure the strike prices that you're using, that there's enough liquidity that whatever contract you're trading, whether it's 5 or 10 or 1, that you're not making up a big balance of the contracts. Well, what's a big balance? You don't want to be more than 5% of the open interest. Okay, and if you can even be smaller than that, 2% or less, fantastic. Okay, we just want to be a little tiny fish with our contracts in the big sea of contracts. All right, we just kind of want to be, just a little fish. All right, let me show you a couple things here today I thought might be interesting for you. Number one, something that we don't show you a lot of, but I thought this might be helpful for some of you here today. What I've done is I've gone to the scan tab and I've come over here to spread book. If any of you have ever looked in the spread book, the spread book shows you what trades are sitting out on the servers. Okay, the Schwab servers, where the orders are sitting. Okay, and it's nice because if you're trying to maybe get an idea of maybe what people might be trading, and you already know about open interest and volume like we've talked about, but you're more interested in specifics, you can do that. Spreadbook should work in your paper account as well as your live account. It takes it a little bit of time sometimes to come up. So like I put in that I wanted to show us what spreads, specifically verticals, although you could choose any of these or all of them. I just chose vertical. And the SPX, it took it maybe about, I'm going to say between 30 to 40 seconds to load. And then it just shows you your top 100 here. But it kind of gives you an idea of maybe what strike prices people are doing, giving you an idea what contracts are being used. Are they using calls? Are they using puts? And so if you're trying to kind of maybe, say you come up with something that you think is maybe what you might want to do for a trade. Obviously, you're not going to know if you see something out there if that's what they wanted to do too, and if it's appropriate, but it just kind of gives you a little flavor for it. And you can see some of these are just small numbers, okay? The biggest number of contracts here so far has been 20. Okay, so are there a lot of just small contract positions going through? Yeah, there are, okay? Just so you know, on this ISE, it's the International Spread Book, which covers not just the servers where Schwab software is, okay, but across indexes. Okay, so that might just be helpful for some of you. Now, I'm going to give you a little lesson because it just makes sense. Those of you that have heard this little lesson, you're just going to have to bear with me, okay? And that is, we're going to be using what's called the probability cone today. I come out to my charts. We already had the moving averages on here. I'm going to come up to my studies. And I have it hiding right now. I clicked on this little eyeball so that it would hide. But basically, go out here, grab you can just type in that much probability of expiring cone, even if you do PROB. it'll come up for you. Go ahead and select it. And then over here, what I want to show you, let's make this a little fatter, is a little bit about the parameters here. I want you to pay attention to this number 68. All right, because that is the probability range we're going to work with. All right. Now, I've told you, and some of you have seen, I'm not the best artist, okay? I can do stick figures, and I can do lines, but I'm not really good at a lot of graphics, but I am going to paint a picture here for you. Let me bring up a blank document. I'm going to make this a little bit bigger, and I'm going to draw a bell-shaped curve for you, okay? And a bell-shaped curve, if any of you had statistics or some math maybe that involved bell-shaped curves, this might sound familiar. Dust off this information in the back of your brain. This is what we call a bell-shaped curve, and this is where all the data points are going to fall, usually within this range. Now, a big chunk of the range is what we call one standard deviation from the mean. And the mean is basically what runs right down the middle. So from here over to this side and from here over to this side represents one standard deviation. And that means 68%. That's where that 68 number came from. 68% of the data points are going to fall in there. Now, when we're talking about higher probabilities, have you ever noticed that we'll talk about, something that might be considered higher probabilities about something higher than 60? Okay, so 68 is definitely more than 60. And that's where we would expect the data points to lie. And then if we want to encompass more of the data, we can come out another standard deviation here. This is not drawn to scale, okay, guys? This represents 95% of the data points, okay? And then we're going to have, a few little random numbers out here on the tail, okay? So we're looking to say, okay, where is the majority of this information going to come from? Well, we want it to come from at least one standard deviation from the mean. All right. That is our drawing for the day. Let's go back to our probability cone that I brought on our screen here. Now, the probability cone is essentially taking that bell-shaped curve and tipping it on its side. Okay. So we're still looking at the bell-shaped curve. And you can see as the curve goes a little more in time, you can see my dates down here, that it spreads out, it gets wider. The probability of the price falling in a certain range further out gets wider, and it's tighter when it's not that far out, right? So if I come out here and I go to, okay, today is October 15th. If I come out here to say the 20th, it's not a very big range for the SPX to likely to be in. Okay, but we come out here to let's go to Thanksgiving time frame. I think Thanksgiving is about this time. It's significantly wider, right? And this is telling us, hey, the bell-shaped curve could be anywhere from I'm going to go 62.46-ish to 71.60. That's the range that the SPX could be by the time we get to, say, Thanksgiving time. But then it'll be broader beyond that. Well, what we're going to use is we're going to use these probabilities to help us. Okay, we're going to use it to help us determine a vertical that we might consider doing. Okay, so we are going to be kind of strategic about it. We're not going to be using the ones that expire today. Okay, we're going to go out a little further in time today. We're going to come out to ones that expire in 14 days from now, which is October 29th. Okay, so we're getting pretty close to Halloween. Do we think anybody's traded these options? Well, we can see. All right, there's a little bit of open interest here, a little bit of volume. More likely, the closer it starts getting to options expiration, the more that volume will pick up, and the open interest, just like I showed you on the ones that expire today, man, that really spikes. Okay, these are going to be priced relatively, what's the best word? Fair. these are still going to be priced fair despite the fact that we don't see hundreds and thousands in here yet. Okay, so like 89.20, or actually 89 by 89.20 is what, a 20-cent spread on a contract that costs 89 bucks. That's a really tight spread, isn't it? Now, stuff like that, you're like, ooh, good, good, good. I'm not going to get penalized for using this expensive option. All right. Let's do this. We are going to come out and we're going to say what our plan is going to be is to do this. We are going to sell options from the October 29 expiration, and we're going to go out beyond where we think the probability cone would be. But what we're going to plan to do is not really hold it till October 29th. We're going to plan to sell it next week. Say a week from today. Today's the 15th. We're going to plan to sell it, or I shouldn't say sell it. Buy the spread back, so we're going to be selling it. We want to be able to buy that spread back about in a week. Okay, so if Ben's gone again and I'm here, hopefully we'll have during that day at some point gone ahead and exited out of the trade, removed our obligation. Hopefully we have a little bit of a credit in our account from that trade. So let's go to our probability cone. We're going to go out to our charts. We're going to come out here, and I'm just not going to maybe move in quite so much. I want to move, make it a little bit bigger and wider here. We're going to go out to the 22nd of October. Oh, look, my mouse is right there. 22nd of October is about right there. Okay. And I'm going to see how much this differs from what it was, maybe an hour ago, 68.72. The market's kind of popped up, kind of recovering back off where it was a little bit lower earlier. So I'm going to say the top side is about 68.72. And on this area of the cone, get onto the 22nd here, October 22nd, looks like it's highlighting 63.50. Okay, so that is the range. The probabilities say that the price is likely to be at that date or by that date. Is it guaranteed? No, everything is theoretical in nature, right? But it kind of gives us an idea based on what volatility's been doing, price action, including this big giant candle here, including that price action. Okay, it's kind of given us the latest status where we think 68% of the data points might be. Now, our plan is to sell beyond those numbers, okay? So I'm going to go ahead, and I should have done this when I was sitting on it. I was going to draw a little tick, okay? So here is our 22nd, and let's get it just exactly right. Okay, we'll go to the 22nd to the 23rd, except that's not on there. All right, 64.78. Okay, that's a little bit different. I had put 63.50, so let's go 64.78. And then let's do the same thing up here. We're on October 22nd. I'm going to go to the 21st, over to the 23rd. So we just kind of see what that is. And that price looks to be about 68.63. So a little fine tuning here. 68.63. The bottom one was 64.78. So our idea would be, okay, if this is where the index is expected to be, well, let's sell something where it's not expected to be. Okay, so it's not expected to be beyond 68.63 or below 64.78. Now let's come out. We're going to use these 14 days till expiration options. And let's work on the put side first. Okay, that area was 64.78. Now, if we go 64.78, probably the closest strike price is going to be probably like the 64.80. So anything beyond it. Anything higher than it is going to be beyond that probability cone. And then it's up to you to balance what you find there in terms of, well, I want it to be a good enough return that I'm happy with it, but I also want it to be still in a higher range, and I want it to be beyond the probability cone. And what you're going to find is many times, and this could vary depending on the index you're using, many times it's going to be between, say, a 20 and an 18 delta. Okay, so we have a lot of choices with, and you could even use, 21 if you needed to. Okay, and so what you might do in this area, and it has shifted a little bit more than I would have liked it to. 64.80, 64.75. What I'm going to look for are contracts. Now, if I could do something that was $5 wide or $10 wide, I might be happy with that. But where it doesn't have a ton right yet, we're just going to expect that it's going to. Okay, so don't feel like you have to come clear out to the 64.50, although if you wanted to and spread it that wide, you could. All right, but let's just go here at the, now it's a 20 strike price, and we're just going to say sell vertical. And we can keep it $5 wide. We can spread it out $10 wide. We're going to spread it out by $10. So we'll go 64.75, 64.65. And again, open interest and volume should pick up as we get closer. And even though there's not a ton on there yet, we're still just seeing a 30 and 40 cent spread on it. Okay. $1.35. Would you be content? I'm going to lock this in for a period of time, which our intent is to be 1 week. Is this a good enough return for you personally? Okay, whatever your rules are. There are some people that say, well, when I do a spread, I want at least a 1% return for every day that the spread is going to be alive before it expires, right? We're out in our short verticals class and other classes where we trade short verticals. We'll talk about that a lot, right? Because sometimes maybe you can sell something 40 days out that's a monthly, or you can sell something that's, 28 days out that's a weekly. And you're like, okay, as long as it has 28 days before it expires, as long as I get 28%, you might be happy with it. Let's figure out what this is right here, okay? So it's jumping around, but we're gonna say that our $10 minus $1.40, that's going to give us $8.60. What's the return on this then? Our max theoretical gain can only be 140. Our max theoretical loss at options expiration is $8.60. Okay, so we're just going to divide that out. We're going to say $1.40 divided by $8.60 is going to give us a percent, 16%. So 16% for being in the trade a week, is that good enough for you? Okay, you get to decide that. Okay, and again, you could come in here and massage the strike prices that you might use. You could play around with the width that you might go, and you might find that you like that comfort range. You might find that you like something different. Okay, that's why it's really good to paper trade these example trades so that you yourself can get a feel for them. All right, let's see what kind of questions you've got here. You guys have been keeping Brent really busy here, but let me take a look. Laura says, I'm not quite understanding why we're looking at two different dates, October 22nd versus October 29. Okay, the reason, remember this is 16%. The reason is we're going to use these options that are 14 days of time, but we're not planning to stay it in for 14 days. We're planning to close it down by next Wednesday. Today's the 15th. Next Wednesday's the 22nd. So we really only planned to be in the trade for 7 days, and that's why we only went that far out on the probability cone. Now, if we had the approach, well, we want to stay in for close to the 14 days, we would have gone out further on the probability cone. We would have come over here to the 29th. Let me get my mouse there. And then the value at that point is looking like about 69.42. So we would have wanted to have maybe sold something where we're not expecting it to go. Okay. And beyond that, area 6940-ish, selling beyond there. Does that make sense? Okay. I want to make sure you do understand that. Chris says, I think she's using the planned exit date price to try to improve the odds, but you're not sure. It's not even so much to improve the odds, but give us an idea of, okay, where is it likely to be in the next 7 days? And then let's sell beyond it, right? Let's sell beyond it. And so we'll just kind of see how this looks. If this is something we'd want to monitor closely, this is something that you might need to make a decision on, or we might need to make a decision on it before we actually have our class time. Okay. But we want to have our plan in place. And then what would we do then? Well, we'd just go out to the next one, right? Then in that case, instead of using October 29th options, we're going to be rolling, I think it's like November 5th. I'm not positive exactly on the date. It might be the 6th. Okay. Would be looking at that expiration. And again, still have the plan, selling it. We're just going to do it for a week. Our plan is to be out pretty quickly. And our expectation is that it's not going to go beyond these boundaries or stay beyond those boundaries. Now, this can move as the index moves and shifts. This little probability cone is going to shift and move, which is why I'm going to keep those little markers there about what it was at the time we entered the trade. Okay, let me make some. Now, Chris says, you could use a higher delta if you wanted. If you wanted to have maybe a little bit better reward than 16% for a week, yeah, you certainly could maybe, come back here a little bit, have a little bit higher delta. Absolutely. Or you could do the inverse and say, well, I want a little bit higher probability, and I would be okay at 16% for 7 days, or even less than 16%. You could be content for 7% for 7 days, or whatever the case might be. Yeah, absolutely. Then you could come out here and just kind of see to your liking. Keep in mind that open interest and volume, especially the open interest, is going to build typically. Obviously not guaranteed, but that has been the general pattern. Okay, so that's why I didn't want you to be freaked out about the numbers, because 7 days out, there's going to be a lot more open interest in here. All right, it's a slight difference than maybe how Ben is doing it. Okay, that very well could be. Higher delta equals higher risk. Yes, higher delta would be higher risk and lower probability. Right now, the one that we're looking to sell, 64.75, has a 76% probability of expiring out of the money. Great, we like 76%, don't we? Yeah, that's a high probability. Now, I'm just going to select on the lock, see if it's changed. Oh, okay. Not that I want to be greedy, but let's get a little bit more here. All right. I'm going to go ahead, send it off. Maybe we can get $1.60 credit on this one. So show you the probability cone one more time. Absolutely. Still putting ourselves out of the probability of assignment, says Ricebird. Yeah, we're still trying to look for that. Where do we think the index isn't going to go? We're going to go sell where we think the index is not going to go, and the probability cone is going to show us that. So to get this probability cone, come up here to your studies, and then just type in PROB on this side, and you'll get your probability of expiring cone. Throw it on here. I made it a little bit thicker so that it was a little bit easier to see than a width of 1. Okay, if you don't like that pinky purple, you could change that too. You can make it whatever you would like it to be. All right. Now, as we have just a little bit of time here, I hope you guys have subscribed to our YouTube channel, because it just makes it so much easier for you to find our content. I love that functionality in YouTube. Let me get let's see, where did he go here? Oh, that's not the right one. I lost my little window. Where did he go? Let me do this. I'll bring it up this way. I had one open here. I actually had Schwab open, and I had our YouTube channel open. So let me just get to our YouTube channel real quick and show you. Because once you subscribe, man, it makes it so much easier for you to find our content. Okay. So here's our talks channel right now, trading index options. Obviously, we're doing that right now. Scott Thompson will be coming up next. So we've got easy class, harder class, now easier class. Okay, stock investing for beginners. He's doing a great job with that class. And if you're a little bit new, or even if you've been around the block a little bit, that might be really helpful to get in on some of that content. So you can see what's coming up. You can set reminders. If you want to be notified, great. We can remind you. You can go into any of our playlists, right? You can come back here and see all the different topics that Ben has been teaching on index options, okay? So it just makes it easier for you to find things, all right? So as we wrap up here, don't forget to subscribe. Please fill out the survey for us. We really do appreciate you taking the time to do that. And since it's not too painful, you know, sometimes it might be something I could just kind of twist your arm a little bit and say, you'd say, okay, I'll do that. All right. But we will use the information that you give us. And like I said, I like to incorporate the questions, the problems, the pain that you're having right now. I like to put those into my upcoming webcasts. I know Ben would like to do that as well. All right. Brent has posted it one more time, and I think he's got it pasted or pinned rather to the very top of the chat there. So you guys, that is my ask of you. If you found this helpful today, hit the thumbs up button as you exit. And I would say if you're trying to do index options, do what Jay Richardson is doing and paper trading them out in your paper money account so you get comfortable, so you get familiar. And in this instance, SPX index options, you know, hopefully you could develop some comfort there so that you would be to answer my question in the beginning, could you handle just trading one index symbol all the time, that you would get comfortable in doing so. All right, you guys, have a nice break, get a snack, refresh your Diet Coke, and we'll be back here at the top of the hour. Brent, thank you for your help in the chat, and our producers as well. All right, we'll see you at the top of the hour. Bye-bye.